What if I told you there's a portfolio out there that's seen over 200% time-weighted rate of return in just 2 years, that's managed a mind-blowing 25% year-to-date performance in 2025? And here's the kicker. It hasn't had a single period in the red. Yeah, you heard that right. Not a single red period. Today, I'm opening up my public portfolio, where my own money's invested, to show you exactly how I've done it. We're diving deep into my unique strategy, the companies making the biggest impact, and my take on navigating what I believe will be a very volatile market ahead. If you're serious about smart investing, hit that like button, subscribe if you haven't already, and let's get into it. All right, let's get right to it. First, the big picture. This portfolio isn't some complex fund. It's built on a disciplined approach with 18 individual stocks. Yes, just 18. Geographically, you'll see I'm heavily weighted towards the USA at 70%, with a significant 30% allocation to China. This reflects my belief in the distinct growth drivers from both economies, despite their differences. And here's where it gets interesting for some. A significant chunk, over 50% of my portfolio, is concentrated in consumer staples and financials. This isn't accidental, it's strategic. I look for value and growth in unexpected places. My investment philosophy here is a blend of growth and value investing. I'm constantly hunting for undervalued stocks across small to large caps. I'm not chasing the latest hype. Instead, I'm seeking out companies with a real service, a truly great business model that I believe will thrive long term. And I'm ready to wait a few years for a stock to perform great. Patience is a superpower in investing. My core discipline? I don't buy any new position if it would immediately make up over 8% of my portfolio. This is about calculated risk at the entry point. However, if a truly great stock, through its own performance, skyrockets and grows to 15% or more of my portfolio, I have no problem letting those winners run. That's how you maximize gains. So, how did this strategy perform in the first half of 2025? My YTT performance is a strong 25%. That's fantastic, especially when you consider the NASDAQ, which has performed 6.6% year-to-date over the same period. And this performance is built on consistent effort, including my monthly $500 investment. It shows you don't need a massive starting capital to build something significant. This portfolio is only in its second year, and its time-weighted rate of return is already around 200%. That's the power of focused research and disciplined execution. And here's the standout feature, something I'm incredibly proud of. I haven't had a single period in the red until now. This isn't luck, it's a direct result of my active strategy, which brings me to, how have I managed to consistently avoid red periods, especially with the market's ups and downs? It's a combination of disciplined risk calculation and proactivity. For instance, regarding major market shifts like the upcoming tariffs, I actively prepare my portfolio. I often sell most of my vulnerable positions before the markets might crash, anticipating potential downturns, and then buy cheaper again once the dust settles. This tactical flexibility is crucial to preserving capital and turning potential losses into buying opportunities. This proactive management and willingness to adapt is where the influence of Stanley Druckenmiller comes in. While my base is Peter Lynch's fundamental approach, finding undervalued gems, being flexible like Druckenmiller, understanding macro risks, and acting decisively is key to my consistent performance and avoiding those red periods. Now, let's talk about the road ahead. Looking at the market for the next few years, my clear expectation is for a volatile market. What does that mean for you? It means some will lose much and few will win. This isn't a market where you can just throw money around and expect easy returns. Because of this, my clear advice is don't invest too easy. It requires careful stock selection, disciplined risk management, and active engagement. Let's pull back the curtain on 3 companies that are really driving this portfolio, representing different facets of my strategy. First up, SoFi. My average buy-in was $8.72, and it's currently up a massive 145%, making it 12% of my portfolio. SoFi perfectly embodies my belief in a real service and great business model. It's a growing player in the financial sector, a smaller cap with massive potential that went through a tough period before I bought in, fitting my buy beaten down potential criteria. Its growth prospects in lending, banking, and wealth management are huge. Next, we have Celsius. My average buy-in was $26.71, and it's performing almost 70%, also representing 12% of my portfolio. Celsius is another fantastic growth story in the consumer staples and discretionary space. It offers a real product with strong, growing demand, aligning perfectly with my strategy of avoiding hype and focusing on tangible business models. I expect continued strong performance here. And finally for this section, JD.com. My average buy-in was $29.79, and it's currently up a modest 4.7%, making it 8% of my portfolio. JD.com is my major China allocation. Despite its current performance, I see it as an undervalued large-cap growth stock with a superb business model and strong fundamentals in the competitive Chinese e-commerce landscape. I'm prepared to be patient here for its true potential to be realized. Beyond those current top positions, what were my biggest overall winners that contributed to that 200% TWRR? SoFi, of course, but also Robinhood both showed explosive performance, truly embodying that Peter Lynch 10-bagger potential I seek. On the flip side, a painful but important lesson was Shopify. I sold major shares of Shopify too early. This highlights that even with a clear strategy, optimizing exits is always a challenge, a key learning point from H1 that I carry forward. Now, let's dive into the charts for two of my key holdings, SoFi and JD.com, to see what the technicals are telling us right now and how they align with my fundamental views and price targets. Looking at SoFi's chart, you can clearly see the strong upward momentum it's been building. The technicals here seem to confirm my bullish outlook. SoFi is currently trading around $21. Based on this technical strength and the underlying fundamentals, I see a midterm price target of $29 to $41. But looking long-term, my target of $60 to $88 suggests a potential upside of nearly 3 times to over 4 times its current value. That's massive potential from here. Now for JD.com. The chart here shows a period of consolidation. Remember, we are still in my buy price zone between 27 and 33. JD.com is currently trading at approximately $26.50. From a technical perspective, I'm watching this area as a potential base. I see a midterm target of around $80. And for the long term, my target of $195 to $237 suggests an incredible potential upside of over 7 to 9 times its current value once this consolidation resolves and the market truly recognizes its value. Looking ahead for H2, 2 companies high on my watch list, which I could potentially buy still this summer, are PayPal and Adobe. Both are incredible companies that I believe are currently undervalued or have strong catalysts ahead, and they fit my criteria perfectly. So there you have it, my diverse portfolio, focused on undervalued growth, navigated H1 2025 with strong returns and not a single red period, thanks to a disciplined and adaptable strategy influenced by Peter Lynch and Stanley Druckenmiller. Remember, in a volatile market, choosing wisely and managing risk is paramount. What do you think of my strategy? Do you agree with my volatile market outlook? Which stocks are you watching? Let me know in the comments below. I read every single one. Don't forget to like this video if you found it valuable, and hit that subscribe button for more in-depth finance insights. And here's a sneak peek. My next video will dive much deeper into the long-term fundamental trends and my full 5-year market outlook. Plus, stay tuned for my specific take on the August 1st tariff deadline closer to the date. Thanks for watching, and I'll see you in the next one.